Good evening, members. It's Mike here from the Armchair Trading Floor. Hope you're all doing very well. A little bit late one this evening. I was hoping to try and get this to you around about 5 p.m. However, just had to run a few different errands and close out a few of the tasks. But here we are. Here we are. Right. We are on the charts. Obviously, I'm going to start off by looking at the SBS. So obviously for you guys, this is the index market, which is used to trade the top 500 stock companies in the US. So the S&P 500 index, something that we've been watching for a long while now. We actually started watching this currency pair because we've seen that it started to get overextended in 2018, around about when price was around about this 2,400 level, because we were anticipating a break to the north side. You can see on here on our Evernote, created on the 25th of October 2019 as per, and we've obviously updated this ever since. As well, we did the screenshot from the 25th of October when we originally created this article, where it's shown that the price is breaking through that 3,000 level, and we've obviously seen that the sentiment for the market was in a very strong buy as well. Moving on, so technically I'm on the monthly time frame right here. With the stock market, it's very important that you guys look at the wider time frames. Your intraday moves are still there to be had, especially if you're trading like breakout strategies, but typically you want to be on your daily time frames and your weekly time frames, low and into minimum. I'd probably say the 4-hour time frame, but again, I'll leave that information for the stock room. So we've called the short from around about this 3,000 to 3,200 range. The price did spike up a little bit higher to the 3.4, but we've seen that the market is correcting as well. On here, we actually had, if I'll just quickly load this up, from where we had sells, we mentioned that we were looking at the price respecting, so price gaps need to be filled, which is around that $2,400 region. So the price wicked and retested the 27% fib, but RSI indicators show that the market has been overbought since 2016 to 2017, because we were sitting well above that 70 RSI measure. Now, for you guys on the monthly time frame, it should be very easy, especially when you're trading stocks, to have an idea, because this tool right here, the measure tool, all you have to look for is all of these pullbacks. Again, with me being on the monthly time frame, I'm able to see the exponential growth which has happened within this particular index, but also it's highlighting to me all of the natural corrections, especially here. So the key ones that stand out to me is October 1st, 1987, where the market plummeted 40%. Then again, we had 1998, 20% pullback. We had the dot-com bubble, which is the year 2000, where the market fell around about the 49%, and then also at this level again where we fell 54%, and this was the global financial crisis 2008. So for those people right now that are preaching we've had a stock market crash or we are in a recession, this is something that which you need to look at the actual level of the correction before it's classed as a recession. Obviously, the definition of recession is that you are in at least 2 consecutive months of negative gross domestic product. Sorry, 2 consecutive quarters of gross domestic product, or the market is pulling back to these 40 to 50% levels. Again, if we look at this most recent correction, which has happened since the start of this year, the market's only pulled back around that 29%. So comparatively, it's not pulled back as great as the crash in 2000 and the global financial crash in 2008. What I expect right now is just a quick breakdown. So you can see that number one, I've obviously drawn on a trend line. So I've got some trend line support right there. We've spiked up, touched this trend line, but a lot of people now, especially with this COVID-19 fundamental news which is consistently on, striking fear into the market and trying to return the sentiment to a balanced sentiment or to a bearish movement. What most people don't understand is that the price is still in an extremely strong buy as per our Evernote. So for me, I still think the market is going to correct itself and push its way up. So we could have a good 3 to 4 years of buying the right amount of stocks and make a decent money while it's still easy to go up. And again, I'm expecting this to last for about 3 to 4 years before we then have this recession period, or an expected start of a recession period, which I think will take us into around about November 2031. However, we'll cross that bridge when we get there, and because we'll know if this first leg is respected, then we are more than likely to get more confirmation of this full recession period hitting. So quick breakdown of this analysis. Obviously I've got a trend line on here, I've got a box region right there, and I've got some arrows up. So what I'm trying to do is really make sense of what the marketplace is doing. First of all, let's start at this crash in 1987. So low to the high, we can see right here, making sense of this price that we had. Price pushed up from low to the high, 50% retracement, failed to break that 0% resistance. Up here, market formed into a double top, which is again the technical reasons of why we experienced this financial crisis. Again, a lot of people were blaming different mortgage products, etc., irresponsible lending. However, technically, this was a very, very bearish move for the fact that we had a rejection of the previous resistance, which happened 7 years prior. Looking at that is, after the market corrected, the market actually extended from its lowest low over 300% over the space of 10 plus years. So why did that happen, especially after a recession that we experienced in 2007 onwards? The reason for that is, again, we looked for where the buyers are approaching. We had buyer interest at this 61.8, and you can see that the monthly candle closed perfectly on the 61.8%, which obviously propelled the price up to the negative 27% and then further to its negative 61%. So the D1, D2 targets. Let's have a look at where the price is right now. I've highlighted this box region because, again, the price, it has respected and it's trying to close around this 2,430 level, which is why we decided to choose and use that zone as one of our targets for when we expected the price to turn down from 3,200 to 3,000 on the SPX. Looking in more detail of that, currently we can see here that we've got this 200 MA, which is sat around about this 1750 level, which is giving me an indication that as we've been retesting and testing these smaller moving averages, we do need to actually correct further and get ourselves down to this level, which is why I think that the price is going to head down this way. Do I think it's going to be such a clean, easy sweep to the downside? Most definitely not. And again, the indicator of that is my previous C leg, which is this 61.8. Is I'm going to use this and look at what the price has done on a technical outlet. So moving on, you can see right here Nothing's really showing from the consolidation period in 2015. And then if I extend this all the way up, we can actually see, so if I extend this to the 3000 region, which was one of our targets prior, we can see that the price respected, again, 2400. I've had multiple one-to-ones with you guys and mentioned this 23.6 fib and the importance of that. But right now we are currently sat at the 38.2 fib. So 38.2 fib, fast moving fib, we could extend higher into 4,164 or even 5,000. However, I don't think that we are going to be seeing these price levels because, again, if we remember this confirmation from 1999 to 2000, our D targets have been fulfilled, so we are looking to try and get some fluctuation in the market. If I take a look at the most recent swing from that correction at the 1756, which again is in line with this moving average, we can have a look and see that the most recent push up is actually a nice A, B, C, D pattern. Again, this 2300 to 2200 is right within our normal buy zones between the 61 and 71% fib, and our negative 27% fib will take us to 3800. So am I expecting a nice corrective move and push up, which is going to fake out a lot of people? Most definitely, because I'm hoping that we're going to get into this zone and then we'll be able to do a deeper correction similarly to what happened over here before the start of the next recession. So that ties up the SPX. Moving into GBP USD, so pound dollar. Called the pound dollar move this morning, caught a nice couple hundred pips on that one over multiple positions, with 14.65 was my stop loss. In times like this, guys, where you've got mass in times like this, guys, where you've got mass volatility, it's important that, maybe 2 seconds, it's important that you guys have a look at the candle ranges, the daily ranges and the pip ranges. It was only 4 or 5 months ago where you would struggle to catch 30-40 pips on GBP USD, whereas now your hourly candle range, fuck me, look at this, we're looking at 130 pips on an average hour. So the volatility is mega. Make sure that you guys are looking at the volatility index, which is on the website. But for now, it's most definitely way too early. Again, we caught a nice pip, we caught a nice move, even though I put out this analysis here on the monthly time frame. I do think that 1.14 is going to hold. However, if I zoom into the 4-hour time frame, you can actually see that taking a lot of this analysis into the equation, sorry, I'll have to take this out even more. So going into the monthly time frame, taking this analysis into the equation, where we are right now, we are prime looking at this trend line, looking at this trend channel to the downside. Could we try and hit 112, 111? More than likely, yes. But for now, what I'm hoping for, especially with the fact that the stock market is hoping to correct and give us confirmation, I still think that this downside target is very unexpected. But on a technical basis, the forex market is a lot more liquid than the index markets as well. So we could see some liquidity spikes all the way down to test 11180, or even potentially spike down to 1.10 per Great British Pound versus the US dollar. On a long-term basis, this actually makes a lot of technical sense. We've been overly bullish on the pound, simply being we had this trend line that we've been scoping since 2016. We've tried it multiple times. We got a nice push up. Over here in 2017, we actually experienced a double top, which sent the price crashing further to the downside, and we've been trying to break above this moving average to try and tap into 1.52, which I do see is a nice long-term target for the pound. Again, split your investment opportunities. Don't take all of your risk at once because you need to stay within the game. If you catch an entry at these lows, it's going to significantly have a dramatic effect on your account. Again, I caught the lows at 1 in 2016. I had buy orders at 1.16 and I rode this all the way up to 138, 140 because I knew that as soon as we were trying to tackle this 1.35 level back then. So have a look at the larger time frames because we are playing out high time frame moves right here. Monthly candles showing a head and shoulder, left head, right shoulder right here, and we are tapping. So it's more than likely that if we break this neckline, which it looks like technically if we break this neckline, the pound could absolutely tumble, and that would signal something dramatic for our economical stability as a country, especially for the people that were in that are in Great Britain. I know that we've got students all across the world. However, I still think that this is too early and too technically smooth that a lot of people will see this move and think this is way, way, way too easy. So for me, we could see a push to the north side, correct at 155, and then I'd be quite happy to see the market do a downturn, and I'd look for other emerging markets to shift money and look at maybe a new change or an upgrade in the financial system based upon new technology or other things like that. Switching on to Aussie New Zealand dollar, again, same kind of structure for Aussie New Zealand dollar, left head, and we've been consolidating right here. It's quite very, very, very volatile, the Aussie New Zealand dollar, but it's probably one of the most safest things to trade at the minute, simply because even though we are wicking and we're very volatile, look at this wick region right here. We're only capturing a space of maybe 40, 50 pips. So on a long-term perspective, even though we've had the price on a long-term downtrend right there, we've broken, retested, and we've created a level of support. We've created a level of support on that retest, and again, we had a clue right here from this reversal back in April 2015. So even though we are bearish, we could see some confirmation. We need to wait for price to get into this 1.00 level to 1.0041, simply because it's probably the safest zone, or even if you were looking at trying to sniper an entry, you'd be looking anywhere within 50 pips off this most recent low, just in case the price returns to the downside. And again, you're targeting a nice 600 pip range right there. For me, I'm going to be accumulating and position trading on Aussie New Zealand dollar, because the XXX New Zealand dollars are usually a very fast moving pair, but at the minute this is looking very, very nice for a nice position trade to try and scale in an opportunity and scale in multiple positions. I'm hopefully going to try and get to maybe about 7 or 8 lots in total over the period of 2020, and hopefully when the sentiment changes for Aussie New Zealand and the 52-week range, that we are going to be looking at stronger buys and trying to tackle breaking above 1.06, and that will give us confirmation that the Australian dollar is going to be trying to correct itself into a deeper bullish correction on, and hopefully up to 1.28. But again, we are in a significantly beneficial time to be trading on the financial markets, or even being able to be in a position to see these prices, because we are in a space of new wealth creation, a space of a lot of fear, and fear equals opportunity. So this is something that you guys should be looking at. When somebody loses a pound, somebody makes a pound, and which side of the fence are you trying to be on? So understanding risk management is very key, but trying to split your risk and not rush the gun. This is definitely not a time to try and rush, because when the market's volatile, you need to actually be so conservative on your risk, and capital conservation is vital to sustain an active account, to sustain a nice percentage growth. But more than likely, especially if you don't have the margin benefits or the leverage benefits, then you don't want to be tied into too many positions, or tied in with one position that you can't get in and out liquid with liquid moves. So it's important that having lower lot sizes in this period is going to benefit you for the long run. What else can we cover while we're on here? So USD JPY, this one is quite simple. I expect the dollar to keep on pushing up. We've got clues over here from the most recent downturns. The price is pretty much technically letting us know that we could head anywhere in between 112 to 114 before correcting. We could just be having like an expanding wedge to the 4-hour time frame, but I still have my eyes on 0.98 as a target. So we've had a nice V-shaped correction. It'd be stupid to short the market right now. Yes, we could retest into 107.70 and then push higher, but for USD JPY, I'm staying well away because we've had a recent failed bearish move, and we need most of the sellers are looking to either enter in at a lower high, which is going to be anywhere under 112, or most buyers are going to be trying to target this 114 level right there. So they're the levels to consider on USD JPY. But for the next, in terms of timing, I feel like the timing element, March, it's a write-off. April, you don't want to be taking any positions right now, because the market again is very, very, very volatile. It's still volatile. It's just something that you need to consider. Again, on these 4-hour time frames on USD JPY, again, wick ranges right there, 85, 90 pips a wick. Like, we're covering, like, it's insane at the minute. We're covering maybe 200 pips a day, which is what we've been covering. So a safe entry on a decent lot size, or how we've been trading over the last year, 2 years, your trading style has to adapt and change to the newer market conditions, and that's something which needs to be highlighted across the board. And what else can we look at? So USD Swiss franc, same again. We're going up. Again, we've had this trend, this channel. We broke 0.98, broke, retested. Look how the technical alignment of this channel within a channel actually works right there, where we've obviously had a channel right there, respected, high, higher low, higher low. We've had this channel within the channel, and you can see how we've had A, B, C pin bar at the 61.8, broken that, spiked into D1 at the -27, which was at the trendline resistance within the channel, retested that break off the 0% fib, spiked into the -61.8, and again we're pushing higher. We've got our key level at 0.99. So for USD pairs, we are going all the way up. BTC USD. So we've got now we've got more confirmation, more data to work at, harmonic pattern right there, and a cipher pattern which basically is showing us that BTC USD, my return of the highs is more than likely going to play out right now. We've been channeling. We had a failed break of this 10,300. Again, I called this move back in, I believe it was October time. So we called this move back in October time, expected that we were going to double top, and we double top perfectly. So you members were warned. I was hoping that we were going to maybe even have a manipulated spike into 11,300, which was again bang on this Fibonacci level, which I've had drawn for a few years now, and we've just bottomed all the way out. So trend line support right there. We've respected that. We've closed above that. Actually closed bang on the 61.8 fib. Sorry, the 78% fib. We're getting some resistance right now. I still think that it's probably a little bit early in the overall market, but for you guys that entered the other day, you should be looking very good now. Probably about 1,000 pips up. I'm still not overly convinced that this is just going to go straight up for the cleanest ride. We are more than likely going to see something which is like this. Sorry, I don't know where that was going right there. We're going to more than likely see something which is like this, pull back. We could even return to see somewhere around about the 4,200 and try and do some kind of stop hunt to fulfill this level again and retest this trend line before then shooting up. So that's something that you guys should consider if you are trading BTC. Again, we're getting into a lot of volatility right now. You can see that on the back end of November last year, we're ranging within these nice kind of 500 to 300 pip range, which is a very safe period, and that's kind of the clue. BTC USD historically, if you're trading around that 300 pip range, you know that it's a safer time to enter and accumulate positions because you're more than likely going to get an impulsive move to the north side or to the downside. You'd never want to be trying to trade BTC where we're covering like 1,500 pips a day, because unless you've got a lot of money in your trading account, we know that based upon leverage and the best leverage for the cryptos, depending on the broker that you're using, you're gonna need a significant amount of cash, and it's better to be a lot more responsible because we know our long-term targets. It shouldn't be a case of trying to rush to this target. Let's look at how the market plays out and scale in the opportunity at the most safest periods as well. So that's the summary for tonight. Thank you all very much for your time in watching this video. If you have any questions, feel free to get in touch with us in the EchoFin app, or if you are wanting to get more information on the newsroom or on the stockroom, etc., just get in touch. Always here. Thank you very much for your time and safe trading.